And if you didn't understand anything while I'm explaining, please interrupt me. So I'm concerning with two problems and try to understand them. The first one, commercial banks create money. How do commercial banks create money? This is question number one. And question number two, which tools can be used by the central bank to control the quantity of money supplied? Okay, so let's start. So the first term, excess reserves. What is excess reserves is the difference between actual reserve and required reserve. So here, see here in the panel 3, I will open my calculator. I have very old calculator. So calculate the reserved ratio. So 100 divided by 500 times 100, it is 20%. So if the required reserve ratio 20%, so 500 times 0.2, so it's equal 100. So here there is no excess reserve, but because this bank kept reserve equal to the required reserve ratio, because it is 100. But if the reserve is more than 100, there will be excess reserve. Look here at panel 2. Since the deposit 100 and the required reserve ratio 20%, so the excess reserve here 80 dirhams. For this reason, the bank, the commercial bank, takes this advantage to give more loans. See here, this is a summary. We started with 0, and then Salim deposits 100 dirham in this commercial bank. So immediately the bank put this 100 in their wallets, or the bank deposits the money at the central bank, which is called reserve. So reserve equal, so always the balance sheet should be balanced. And then because we have excess reserve of 80, the bank gave loan to somebody of 80. This guy deposits 80 dirhams as a new deposit, and then the bank gave more loans till we reach to this equation, So see here, when loans converted into deposits, the money of the money supply will increase. So here 80 dirhams as a new deposit gives the bank an opportunity to give a new loan worth of 64 dirhams. Let's go in details and look at this very important multiple tables. And this table will facilitate for us to answer the question, how do commercial banks create money? So see here, let's start with the first commercial bank. Let's start with this story. Salim deposits 100 dirham in this commercial bank. This commercial bank put 100 as a reserve. And then because of the required reserve ratio is 20%, this commercial bank, so how I calculated 20% required reserve ratio, 20 divided by 100 times 100. So since the required reserve ratio is 20%, so 100 times 0.8 equal 80 dirhams. So why I say 0.8, 1 minus 0.2 equals 0.8. So if I got a deposit of 100 and the required reserve ratio 20%, the bank can give a loan of 80 dirhams. This guy deposit the money in the same bank. So total deposits will become 180. So and then this guy who got a loan and deposit the money in the commercial bank, he withdraw the money. He write a check on this bank and withdraw the money. So when they withdraw the money, reserve as cash decreased by 80 dirhams and deposit left with only with 100, which is equal to the initial deposit made by Salim. And here the balance sheet is balanced. Why? Let me summarize panel 3 with bank 1. Salim deposits 100 dirham. The bank kept 20 dirhams as reserve, and the bank gave loan to Lana of 80 dirhams. Lana withdrew the money and she has an account in another bank, bank 2. So she deposits 80 dirhams. In the same procedure, the bank gave loan 80 times 0.8 equals 64. So the bank gave a loan to Farhana worth of 64 dirhams. So 80 times 0.8. Why it is 0.8? 1 minus 0.2. 0.2 is the required reserve ratio. So Farhana deposits 64 dirhams. And then Farhana withdrew the money. She wrote a check on bank 2. So we left with this. Lana deposit 80 dirhams. Bank 2 kept 20% of 80 as a reserve and gave loan to Farhana. Farhana has an account in a third commercial bank. She deposits 64 dirhams. So the bank has a reserve of 64. Then 64 times 0.8 equal 51.2. So the bank gave a loan to Hawa. Hawa deposits 51 in the bank. So total deposits 61 plus 51 become 115. And then Hawa withdrew the money and she deposited in the bank number 4. She deposited 51.2. The bank gave 80% of this amount to somebody else, such as Alia Hassan. See here, the initial deposit made by Salim makes multiple increase in total deposits worth of 500. Why I say 500? Because there is a term called money multiplier. Money multiplier equals 1 divided by 0.2. 1 divided by 0.2 equals 500. So any dirham as a reserve will create multiple increase in deposits of 5. So since Salim deposits 100, so and it becomes a new reserve, so the bank create 5 times than this reserve. And since the required reserve ratio 20%, so from this 500 as total deposits, the bank can give loans of 80% and keep as a reserve of 20%, which is required reserve ratio. Okay, hopefully you understand this. And during the revision, I can repeat the story. So what is money multiplier? 1 divided by required reserve ratio. So let me ask Farhana to read Money Multiplier. Farhana, can you read Money Multiplier?
Yes, doctor.
Not from the beginning, only Money Multiplier here.
Okay. The
Yes, yeah,
multiple by which the multiple by which deposits can increase for every dollar increase in reserves equal to 1 divided by required reserve ratio.
okay. So when Salim deposits 100, it becomes a reserve of 100. The total increase in deposits equals 500. 100 times 5. From where I got 5, 1 divided by required reserve ratio. So in this case, the commercial banks create new money when loans converted into deposits. Deposits is part of money supply. What is money supply? Equals cash held by general public plus current account or demand deposits. So the commercial bank when commercial banks give loans and loans goes as new deposits, the money supply will increase. Let's go to now, as I explained, I'm checking my watch. Okay, so still we have time. Okay. So what is monetary policy? Monetary policy, the rule of monetary policy, or the monetary policy is conducted by the central bank, United Arab Emirates Central Bank. And the central bank is a governmental organization, works behalf of the government to ensure the financial stability in the country. So during recession, such as what happened during coronavirus pandemic, the central bank should increase the quantity of money supplied. But during expansion or inflation, the central bank should decrease the quantity of money supplied. So again, what is the quantity of money supplied? Equals two portion. Cash held by general public or cash in circulation plus current deposits. And a huge part of current deposits is created by commercial banks. So the central bank has other duties, but I prefer to focus on controlling the quantity of money supplied. This is the balance sheet of the central bank. So the central bank in the assets has something called Treasury Securities or national bonds. What is national bonds? What is a piece of national bond? It's a piece of paper issued by the government or by the Ministry of Finance. It wrote on it, I'm the government of UAE. I promise to return back 1,000 dirhams, and I will give the holder of this piece of paper 10% interest rate. So assume Ali Hassan will purchase some national bonds as sort of financial investment to diversify her investment. So in front of this piece of papers, the central bank can print banknotes and distribute it among people, which is called currency in circulation. So currency held by general public is liability against the central bank. Plus reserve balances, because commercial bank keeps their reserves at the central bank. So this is liabilities. So this is the liabilities, and the assets are national bonds held by the central bank. And let's see, it's not important the balance sheet of the central bank. The central bank uses three tools to control the quantity of money supplied. I will ask Lane to read this, starting with the word three.
Three tools are available to the central bank for changing the money supply. First, changing the required reserve ratio. Second, changing the discount rate. Three, engaging in open market operations.
Okay, so the central bank, the UAE Central Bank, or the United States of America Fed, Federal Reserve Bank, بنك الاحتياط الفيدرالي, the UAE Central Bank has three tools: reserve ratio, discount rate, and open market operations. So I'm going to explain them, but I need from your side to concentrate on the conclusion. So for example, during coronavirus pandemic, there is a recession. What the government should do, what the central bank should do to increase the quantity of money supplied. So the answer is to change one or two or three of these three tools. And we will see how the change in each one will affect the quantity of money supplied. So I need you to understand the conclusion. See here, a decrease in required reserve ratio from 20% to 12.5% will increase the quantity of money supplied. Let's start with the central bank sets a required reserve ratio of 20%, and accordingly we will see this case. The balance sheet of the central bank is as follows. In the assets, the central bank owns national bonds of 200 dirhams. It's easier for me to say $200 billion. I will say 200 dirhams. And in the side of liabilities, so the central bank owes or other parties owns money against the central bank. So 100 reserves, this is deposits from the commercial banks in the central bank. And here, currency in circulation, the general public holds cash worth of 100. Since the central bank printed this paper, so we as a general public owes money or owes value against the central bank. Okay, let's see here. Since the commercial banks have a reserve of 100, required reserve ratio 20%. Calculate for me money multiplier. 20. So what is money multiplier? 1 divided by 0.2. It is 5. So immediately, since commercial banks have a reserve of 100, we expect the deposits will be 500 and the total loans given to others will be 400. So there is no excess reserve. Okay, and then let's say suddenly the central bank changed the required reserve ratio from 20% to 12.5. See here, the central bank is the government, and commercial banks, which are private companies, have to follow the instructions made by the central bank. So, okay. So here, 12.5. In the balance sheet for the central bank, there is no change. The same data I put it here. But when the central bank changed the required reserve ratio, it creates a problem to the bank. Why? now reserves, as you see, it is 100. Calculate the money multiplier. Calculate the money multiplier. 1 divided by .125 equal 8. So from this reserves, total deposits will be 100 and loans will be 700. So from how I calculated 700, you can easily say 800 minus 100 equals 700, or 800 times 1 minus 12.5. So 1 minus .125 equal .875 times 800 equals 700, if you follow me. So what happened here, since the required reserve ratio decreased, it gives the commercial banks more ability to give more loans, because here 100, it includes excess reserve. We don't need to keep 100 reserves even from this 500. We don't need, from 500 deposits, we need less than 100 dirham as a reserve. So the bank will give, the commercial banks will start to give more loans, and loans will convert it to deposits again till we reach to this new balance sheet. So what happened here? Total deposits increased by 300, loans increased by 300. Let's calculate money supply in the first version and in the second version. What is money supply in the first version? Currency in circulation held by general public, which is equal to 100, plus demand deposits of 500. So money supply equals 600. So when the central bank decreased the quantity of money supplied, that will lead to an increase in quantity of money supplied to 900. How it becomes 900? Currency in circulation 100 plus deposits of 800. So a decrease. So during coronavirus pandemic, during recession, the central bank should decrease the required reserve ratio. It will give commercial banks more ability to create loans from the current reserves. If loans converted to deposits again, it will give the commercial banks multiple ability to increase deposits. So deposits will increase multiple times, and the money multiplier will become higher than the previous. Let's go to discount rate. What is discount rate? Discount rate is an interest rate used by the central bank when the central bank lends money to commercial bank. So during recession, during coronavirus pandemic, the central bank should lower the interest rate. So that will encourage commercial banks to borrow money from the central bank, because borrowing will be less costly. Okay, let's see the situation. So here in the first version, commercial banks don't borrow money from the central bank. And this is the balance sheet of the central bank. The central bank owns national bonds of 160, reserves deposited by commercial bank worth of 80, currency in circulation 80. Let's go to the balance sheet of the whole private banking system. Banking system includes commercial banks. So reserve equals 80. So if the balance, if the required reserve ratio 20%, if the required reserve ratio is 20%, what will be the money multiplier? 1 divided by 0.2, which is 5. So since I have a reserve of 80, so 80 times 5, the money multiplier, 80 times 5, the money multiplier, total deposits will be 400. So reserves of 80 will create deposits of 400 through giving loans. So why the loans 320? So 400 minus 80, 320, or you can say 400 times 0.8. Why it's 0.8? 1 minus required reserve ratio. 1 minus dot 2, it is dot 8. So 400 times 0.8 equals 320. Okay. So now the discount rate becomes lower. Assume the central bank gave loans to commercial bank worth of 20 dirhams. So what he will do, you cannot imagine, it's so easy. He will write in the side of assets loans of 20 dirhams given to commercial banks, and he will add the account of reserves, which is deposits by commercial bank. There is an addition of 20% of 20 dirhams. So this is the change in the balance sheet of the central bank. Let's go to commercial banks. So since I have now reserve instead of 80, it becomes 100 because the reserve increased by 20, which is a loan given from the central bank. So I have a reserve of 100. A reserve creates multiple deposits. Use the money multiplier. Since the required reserve ratio is 20%, the money multiplier is 5. So a reserve of 100 will create total deposits of 500. So deposits will increase from 400 to 500. So from this 500 times 0.8 equals 420. So this is loan given to private companies. And in the liabilities, we have to write 20 with this amount owed to the federal, because the central bank gave loans to commercial bank, and here we recorded these loans as amount owed to the central bank. So the balance sheet is balanced. Let's calculate what happened to the quantity of money supplied. A quantity of money supplied in the old version equals currency held in circulation or currency held by the general public 80 plus demand deposits 400. So it is 480. Now, when the central bank decreased the discount rate and commercial banks are encouraged to borrow 20 dirhams, the commercial bank in the money supply increased to 580. Currency of 80 plus deposits of 500. So it is 580. So see here, when the central bank gave a loan of 20, money supplied increased by 100 from 400 to 500 as deposit. So the money supply increased multiple times than 20. 20 times the money multiplier 5, it is equal 100. So the increase in reserve by 20 allows commercial banks to increase their deposits by 100. How? By giving loans. They gave loans of 100, loans converted to be a new deposits. Let's go to open market operations. What is open market operations? The central bank can sell or purchase national bonds. So let me, for me, I cannot memorize the information till I start to analyze the information logically. So what will happen if the central bank sells national bond? So the central bank will sell national bond to Farhane. What will happen? I will give Farhane, I'm the central bank, I will give Farhane a piece of paper which is called national bond. It is not part of the money supply, national bonds. When we give a definition to money supply, it is cash, currency in circulation, plus demand deposits. So national bond is not part of money supply. So the central bank, if the central bank sells national bonds to Farhane, Farhane has to pay money. When I say pay money, the money goes to the central bank. So the money supply will decrease. But if the central bank purchases national bonds, I will take national bonds from Farhane and I will give her money. When I say I give her money, money supply in the market will be part of money supply. The money supply will increase. And we will see in this example. So don't worry about tables. I need you to understand the conclusions. I need you to understand the conclusions. See here the story with the interaction between the central bank, UAE central bank, and Farhane, who is a very rich businesswoman in the UAE. So let's start with the first version. What we have information. The balance sheet of the central bank shows that the central bank owns national bonds worth of 100. Reserves, which are deposits made by the commercial bank, equals 20, and currency 80. Currency in circulation 80. Let's go to the balance sheet of commercial banks. Reserves 80. Reserves, sorry, 20. Reserves 20. 20 times 5 equal 100. Why I say it's times 5? Because I assume the required reserve ratio is 20%. 1 divided by 20%, it is 5. So deposits will be 100. So 100 times 0.8, it will be 80. So always check whether the balance sheet is balanced. So the left side equals the right side. Let's go to Madame Farhane, who is the richest lady in the UAE. She has 5 million dirhams. So if Farhane has a 5 million, can we call her the richest? No. But she's rich, but not the richest. Okay, so Farhane put deposits of 5 dirhams in commercial banks. So she owns 5 dirhams. She has no debts at the moment. Her net worth is 5. So this is the balance sheet of Madame Farhane. Let's see here. the central bank decided to sell 5 dirhams of national bonds. So the central bank decided to sell 5 dirhams of national bonds. So national bonds decreased from 100 to 95. So when the central bank sells 5 dirhams, he will receive 5 dirhams from somewhere. So reserves of commercial bank will decrease by 5. Currency in circulation is the same. From where we got 5, actually from Farhane. Farhane deposits her money in commercial bank. So the money transfer from Farhane through commercial bank to the central bank. So reserves of commercial bank decreased by 5. Let's go to the balance sheet of commercial bank. The commercial bank used to keep reserves of 20. The reserve will decrease by 15 because commercial banks pays 5 dirhams to the central bank. Also deposits will decrease by 5. So see here, we will cut 5 dirhams from reserve as cash, and we will cut 5 dirhams from total deposits. The loan is the same. What happened to the balance sheet of Farhane? Just the deposits at the central bank, at the commercial bank, changed to be national bonds. So Farhane owns now national bonds worth of 500 and her wealth equal of 5 dirhams. So Farhane, instead of putting her money as a deposit in commercial bank, now she purchased national bonds. Okay, there is a problem with commercial banks. Why? Calculate 15 divided by 95. It is around 15%. So now, since the commercial bank lost 5 dirhams and deposits become 95, do commercial bank follows the required reserve ratio of 20%? The answer is no. Now the reserve ratio is 15%. So the commercial banks has to obey to the required reserve ratio of 20%. So 15 dirhams as a reserve times 5 as money multiplier equals 75. So now the commercial banks will call some of the loans. So total loans will decrease by 20. And total deposits will decrease also by 20 from 90, will decrease by 25. So the first decrease when Farhane withdraw money to pay to the central bank, which is 5, and additional decrease when commercial banks clear some of their loans, so further reduction in deposits. So the total decrease in deposits from 100 to 75, the total decrease is 25. Nothing changed in the balance sheet of Farhane. Let's follow the change in money supply. The money supply before selling national bonds, it was 80 plus 100. So the money supply is 100. Currency in circulation 80 plus demand deposits of 100. After the central bank decided to sell national bonds of 5 dirhams, the money supply decreased from 180 to 155. So can you calculate 180 minus 145? It is 25. So when the central bank sells national bonds of 5 times the money multiplier 5 equals 25. So if see here, if the central bank made a decision, there will be multiple effect on money supply through commercial banks. So do you accept this scenario during coronavirus pandemic? The answer is totally no, because now it's not a good time for the central bank to sell national bonds. It's better for the central bank to purchase national bonds from the open market. So there will be multiple increase in money supply, and that's what we needed during the recession.